Real estate investors, are you ready to supercharge your investments? In this video, find out how a 1031 exchange can help you grow your portfolio while deferring taxes. If you're looking to maximize your real estate investments and defer capital gains taxes, I'm going to break down how 1031 exchanges work, the rules you need to know, and how you can use them to grow your portfolio. I'll also walk you through a 1031 exchange scenario so you can see the benefit firsthand. Whether you're new to real estate and have been thinking about investing or looking to refine your strategies, by the end of this video, you'll have a deeper understanding of this incredible tool and have the confidence to use 1031 exchanges to your advantage. Welcome to my channel. I'm Fana, your dedicated local Las Vegas realtor. My mission is simple: to make your real estate journey here in Las Vegas as smooth and enjoyable as possible. From finding the perfect property to negotiating the best deal to a stress-free transaction, I've got your back every step of the way. Now let's get started learning how to maximize your investment potential and take your real estate game to the next level. What is a 1031 exchange? A 1031 exchange is a tax strategy that allows you to defer paying taxes on the profit from selling an investment property by reinvesting that profit into a new similar property. You're probably wondering, what is considered a similar property? Also referred to as a like-kind property. Here are the key requirements. The properties involved must be of the same nature or character. Even if they differ in grade or quality, they must be used for investment or productive use in a trade or business, such as rental properties, office buildings, or land for development, not for personal use. For example, you can exchange an apartment building for a strip mall, as both are investment properties, or a rental house for another rental house. There are a few exceptions to this rule. Conversion to investment property. If a property was initially used for personal residence and then converted to a rental property or investment property, it might still be eligible for a 1031 exchange. However, it's crucial that the property be used as an investment for a significant period before the exchange, usually about 6 to 12 months. This helps demonstrate to the IRS that the property is held for investment to meet IRS requirements. If a personal property is used for business purposes, it can qualify for a 1031 exchange, but there are specific conditions to consider. Primary business use. The property must be used primarily for business or investment purposes to qualify for a 1031 exchange. If a portion of the property is used for personal purposes and another portion is used for business, only the business portion can be eligible for the exchange. Allocation of value. You must clearly allocate the value between the personal and business portions of the property. For instance, if you have a mixed-use property with 60% used for business and 40% for personal use, only the 60% business portion qualifies for the 1031 exchange. Price. In a 1031 exchange, there are specific requirements regarding the prices of the properties involved to fully defer capital gains taxes. These requirements primarily relate to the value of the replacement property relative to the property for sale. Here are the key rules. Equal or greater value. The value of the replacement property must be equal to or greater than the value of the relinquished property. The value includes the selling price of the relinquished property minus any selling expenses. Selling expenses are costs associated with the sale of the relinquished property. These expenses are subtracted from the gross selling price to determine the net value. Typical selling expenses include real estate commissions, legal fees, escrow fees, title insurance, transfer taxes, recording fees, appraisal fees, advertising and marketing costs, repairs and improvements, and home warranty. These selling expenses reduce the amount of proceeds that are reinvested into the replacement property, so they are an essential consideration in a 1031 exchange. Mortgage and debt considerations. If there is a mortgage or any other debt on the relinquished property, the replacement property must also carry at least as much debt. Alternatively, the investor can add additional cash to offset the difference. For example, if the relinquished property has a mortgage of $500,000, the replacement property should have a mortgage of at least $500,000, or the investor should put additional cash to cover any shortfall. Let's look at an example. Relinquished property value is $1 million. The replacement property value must be at least $1 million to defer all capital gains taxes. The relinquished property mortgage is $300,000. The replacement property mortgage must also be at least $300,000 or supplemented with additional cash. This method is particularly useful If the investor wishes to avoid taking on additional debt, or if the replacement property's value or financing terms make it challenging to match the previous mortgage. These rules are critical for investors to understand in order to maximize the deferral benefits of a 1031 exchange. Always consult with a tax advisor to ensure compliance with IRS regulations. Now let's go over the steps to take. The first step in a 1031 exchange is to sell your investment property. Reinvest the proceeds. Instead of keeping the profit, you use it to buy a new like-kind investment property. You have specific deadlines. The first deadline is the identification period. You must identify potential replacement properties within 45 days of selling your old property, which starts on the day you sell your original property. Now let's get a little more detailed about what identify means. Specificity. The properties listed must be specific and identifiable. Generic descriptions or vague listings won't meet the IRS requirements. Written documentation. You should provide a written list of potential replacement properties to a qualified intermediary for the IRS. Number of properties. According to IRS rules, you can identify up to 3 properties regardless of their market value, or you can identify more than 3 properties if their combined value doesn't exceed 200% of the value of the relinquished property. Exchange period. You must complete the purchase of the new property within 180 days of the sale of your old property, which means the actual closing date of the new property. It's a strict deadline and it includes weekends and holidays. Let's talk about how it solves a tax problem. Normally, when you sell a property for more than you paid for it, you owe taxes on the profit, capital gains tax. A 1031 exchange lets you postpone and defer paying these taxes until you sell the new property. It preserves investment. By deferring taxes, you can use more of your profit to invest in a new property, which can potentially lead to greater returns in the future. Now let's look at a real-life scenario using a 1031 exchange calculator. Let's say John is considering a 1031 exchange for his rental property. He wants to estimate the potential tax savings and investment benefits from the exchange. Details John inputs into the calculator. The original property sale price, let's say $500,000. The original property purchase price, let's say $300,000. The estimated sale costs, for example, agent fees, closing costs, etc., $30,000. The new property purchase price, $600,000. Depreciation taken, $50,000. Capital gains tax rate, 20%. First, let's calculate the gain. You take the original property sale price at $500,000 minus the adjusted base price, which is the original purchase price plus depreciation taken. $300,000 plus $50,000 equals $350,000. So the total gain is $150,000. Next, let's estimate the amount of tax that will be deferred if John uses a 1031 exchange. We'll take the total gain, which is $150,000, times the capital gains tax rate at 20%, which equals $30,000. So if John uses a 1031 exchange, he won't have to pay this $30,000 capital gains tax at this time. Next, we'll estimate the amount of cash available for the new purchase. Take the sale price at $500,000 minus the sale costs at $30,000, for example, real estate commissions and escrow fees. This leaves John with $470,000 for total investment in the new property. If the replacement property is $600,000, John will need to invest another $130,000 into the new property. John sees that by using the 1031 exchange, he defers paying $30,000 in taxes, which he can reinvest into his new property. The calculator also helps him understand that he needs an additional $130,000 to complete the purchase of the new property. Thanks for watching. If you're thinking about investing in Las Vegas or you have any questions about the local real estate market, I'd love to help. Feel free to reach out anytime. My information is in the description below. Like this video if you found it helpful, subscribe for more real estate insights, and drop a comment below if you have any questions. I'd love to hear from you. I'll see you on the next video soon.